The broadcast is now starting. All attendees are in listen-only mode.
For those of you who have joined us early, this is Jim Fritz. Still got about 3 or 4 minutes to go. We'll give everybody an opportunity to sign on. Until then, I'm going to stay muted. But thanks for joining us this afternoon. And I look forward to walking through with Mass Merch Exec Review with you. Hello again, this is Jim Fritz. It's 2 o'clock straight up. Just going to give people another minute or two, and then we'll fire this up. We've got 2 minutes after the hour, so let's get going. Again, this is Jim Fritz with F&D Reports, and welcome to the Mass Merchandisers Executive Review. Just a couple housekeeping rules. By all means, if you have questions, type them in the chat box. If I can answer it here and now, we'll do that. If not, we'll have to take it offline and get you the information you need. A little bit about how we're going to proceed today. I'm going to start out, as I like to do, with some of the macro trends, what's going on. And there are some, good stories here in the mass merchandise sector this time around after 2022, which was a pretty interesting year. And we're going to talk about those and then also talk about them in relation to a couple of credits. So we're going to look at Big Lots, which I think everybody's fairly interested in. We're going to look at the Dollar Tree and Family Dollar and also at Walmart. But again, those are more for the story, not because of anything in particular that's going on with them. So let's go ahead and get started. Let's start with kind of the macro here. So last year, GDP growth slowed down a bit, just 2.1%. And our advance estimate for this quarter, for the first quarter, was just 1.1. Now, interestingly, the full year is projected to come in less than 1, which is telling us that we may have some negative quarters coming along. Kind of countering this is the fact that employment still remains strong. There are still 2 jobs out there for every 1 person who's theoretically looking for a job, which may be a counter to the recession argument. The big story in 22 was what happened to discretionary spending. Kind of fell off the charts, and we'll talk about the effects that had. And then really what's changed also is consumer behavior. In addition to not spending money on discretionary items, they are seeking value, which is changing where they go and where they shop. Now, the big boxes have been able to invest in price to stay competitive. And deep discounters, it's interesting, we're seeing some demographic shifts there with higher income people going to the dollar stores for the first time. Both Dollar Tree and Dollar General, they track somewhat of those statistics on their clients. Wanted to turn your attention to the consensus forecast below. This is from the Federal Reserve Bank of St. Louis. GDP, you can see, is the solid black line. Finished the year at that 2-point number. And now they're a little bit more optimistic for the year there, with a number up close to 2. I guess everybody looks at things a little bit differently. But to me, the most interesting part of this chart is the unemployment number, which is that dotted blue line. The St. Louis Fed is forecasting this to actually go back up above 4%. So that's kind of an interesting trend going forward that we're going to have to keep an eye on. The inflation number there, the red line, that's PCE, which is the personal consumption expenditures. It's a little bit different than CPI. It's more of a core number, and also I think they're being a little conservative or hopeful on that estimate there. So really the big stories in 2022, if you think about it, was inflation, there was inventories, and still supply chain. So in terms of inflation, March we saw some good numbers, just up 0.1% March over February. Our core inflation is still up 5.6. Now, I want you to keep something in mind. Everyone panicked and we got out of hand about inflation in 2022, but in 2021, core inflation was up 5.5%. It really wasn't much different. But in 2022, it really seemed to hit home. Fuel costs were down again in March, and then that's kind of the big number that's pulling the overall number down. And for the year, for 2023, we're looking at 3 to 4%. The projections are pretty across the board for 2023 inflation. As you know, the Fed's target is always 2%, somewhere in that vicinity. I don't know that they're going to hit that here in 2022. The chart there breaks out as of March what the year-over-year changes have been in the various categories. And again, you see energy is actually negative. So that's what's pulling the overall inflation rate down. So in terms of inventories, I want you to think back to the first quarter when the first quarter numbers in 22 started coming out. Everyone panicked. Well, not everyone, but a lot of people panicked because Target turned in some really poor numbers. The Walmart numbers were unimpressive. We had our two bellwethers, in essence, not performing overly well. On the home improvement side, Home Depot did not have a good quarter. Lowe's did not have a good quarter. And one of the main things we noticed at that time was this glut of inventory. And what happened was, again, I like to say inflation really caught up with people. And they realized how much more it was costing them at the supermarket, and they pulled back on discretionary spending. So inflation, again, hurt people. Supply chain costs were hurting the retailers. And what I'm showing you here is the change between the first quarter year-over-year change inventory versus the fourth quarter. And as you can see, some people had some very large changes in first quarter, which everyone was thinking, oh, it's going to lead to extensive discounting, and that did to some degree. But by fourth quarter, most of the retailers had kind of caught up with things. There are a couple of folks who didn't, Dollar Tree and Dollar General, they came down, but bear in mind you have a lot of store growth in there. And interestingly, the Canadian retailers, for some reason, they were not up that much in the first quarter. And part of that had to do with supply chain issues. Canada was still experiencing quite a bit of supply chain issues, and their issues are a little bit different than ours. So they rebuilt things back. And if you go through and look at the Canadian Tire reports in Dollarama, management is very comfortable with where their inventory is right now. In Dollarama, the fact that they're 60% over the fourth quarter of 22 is not concerning them whatsoever. But again, the drivers here were two things. There's the slowdown, but then also most of the inventory that was hanging out was discretionary, which has a higher dollar value. And people had to spend more on staples due to inflation, so they had to cut back somewhere. And again, most of the companies worked through the excess. This chart is what we put out with our quarterly summaries, and I just like to throw it in here so we can take a look at a couple things. Obviously, you see Big Lots is our only participant there in the negative comp, the negative sales range. Again, that goes back to the whole discretionary issue, and we're going to talk about Big Lots in detail. Now, the other interesting numbers on here is the e-commerce at Costco and at Target. Now, Costco, they've had 3 quarters in a row now where e-commerce has actually gone negative. And the driver behind this, interestingly, it's the big ticket items, which they sell quite a bit of appliances, tires, and jewelry. A lot of that is sold online at Costco. So with that falling back, it's really dragged their online growth down for the last couple quarters. Target, I think it's a combination, a little bit discretionary, but I also think it has to do with people getting a little bit more traffic in there. Canadian Tire, I think there, again, it was just some pullback. Canadian inflation is running very similar to the US. So they had their problems there too. But this is, again, we put this out with the quarterly summary report. If you don't recall getting that, shoot me a note and I'd be happy to send it to you. So let's take a look at some metrics. And we'd like to start with sales. And for the most part, everybody experienced sales increases. Really, the only group or only entity that really didn't was Big Lots. They were down fairly significantly. But overall, even considering the inflation, sales weren't that far off. Now, the interesting thing is that sales growth did not match inflation growth, which we thought it might do more of that. And again, a lot of this is driven by staples. So we have companies like Walmart, Costco, Target, where staples make up a fair amount. Walmart, it's 55%-ish. Costco is actually up closer to 70%. Target's the lowest, down in the low 20s. But again, this is what was propelling sales for a lot of these companies. Now, the interesting thing here, too, is that, again, we have the shift in consumer behavior. People turn to the dollar stores for food and staples. And they sell a lot of this. Dollar General, for fiscal year 2022, 80% of their sales were consumable related. For Dollar Tree, it was about 60%. And people are going there. Again, they're trading down. They're reporting seeing new customers in there, people who have higher incomes. And it's helped propelling their sales. So Dollar Tree, their consumables were up about 8%. And Dollar General actually was up almost 15%. So it shows you, again, the shift in this consumer behavior. Okay, moving on to store count. We still see the dichotomy here, and that has to do with the big boxes really not opening much in terms of stores, but the smaller, the discounters, Dollar General, Dollar Tree, Ollie's is still opening stores, Five Below is opening stores. The big boxes, most of their CapEx is going into digital and remodeling. Dollar stores are growing rapidly. And interesting, the supply chain issues apply here also, because what we're seeing is they're delaying openings because they can't get the right materials in the right place at the right time. And then the other aspect of this is that many municipalities who have to approve these new stores and the whole permitting process, that's still bogged down because of COVID. A lot of the municipalities have not bounced back personnel-wise, and they got backlogged. So again, interesting here, supply chain effects. But we're still seeing growth out there, but we're still seeing, again, with the bigger stores, the heavy investment in the digital side. Comps, fiscal year 22 is kind of a mixed bag, I thought. Some stores saw inflation-driven comp improvements with larger tickets but lower traffic. Some of them were lapping very tough comparisons. I mean, for instance, look at Five Below. They were actually down 2%, but they were lapping a 30% comp. Now, the 30% comp is in itself deceiving because that was lapping the year before when they actually closed the stores. Target was lapping a tough comp at almost 13%. Big Lots, again, noticeable outlier here. They're down 13% for the year, but they were also down last year. And there are some other reasons why their comps were down so much, which we're going to talk about when we cover them in the spotlight. So speaking of Big Lots, let's jump into their spotlight here. As I said in my fourth quarter report, Big Lots is kind of the poster child for the fall off in discretionary spending and the shift over to staples. Discretionary, again, was 75% of sales in fiscal year 22. And these categories include furniture, seasonal, your soft home, hard home, and electronics. And as you can see, Big Lots has had now 7 quarters of negative comps. But to give you an idea, in fourth quarter, furniture comps, which is Big Lots' largest category, comps were down 28%. This was followed by soft home, which was down 17%. So people really pulled back. The 25% of consumable food there wasn't going to cut it. Now they're still projecting 1Q of 23 to kind of look like fourth quarter. And like still some companies have started giving full year guidance, but Big Lots in essence said that there are too many variables out there for them to be giving full year guidance. Now the other problem Big Lots had, again, back to supply chain. During the fourth quarter, they lost their largest Broyhill vendor. They just closed up shop one day, and interestingly enough, even the stuff that was in transit, they had the trucks turn around. And this kind of reflects, to me, a bigger issue with supply chains, and that is the mantra in supply chains for years has been, let's cut costs, got to drive costs out of the system, not just in how we transport things, but also for the products themselves. Just-in-time inventory is, again, another mantra where, oh yeah, we're just going to keep enough on hand and we're going to get that stuff shipped to us quickly. Well, the problem is very often this leads to companies relying on one or just 2 or 3 vendors. And all it took was a hiccup. And COVID was that hiccup that really kind of threw a monkey wrench into everything. Now, granted, we're post-COVID now, but a significant percentage of companies still say that their supply chain is not back to normal. And maybe the good news here is it's got people rethinking their supply chains. And if you go to something else, something like chips, microchips, we import a lot of those. In 2021, we imported about 60% of our chips. We also export a lot of chips. But so the government responded last year by passing the CHIPS Act, which is going to pump $50 billion into the domestic chip manufacturing. But still, that's a 3 to 4 year window or more to build a sophisticated chip factory, because we do not build earlier generation chips here in the US. That's something we import. And interestingly, that's what caused the problems with being able to find cars during the early part of the recessions, because they didn't have the chips, because they use, in essence, dumb chips in most automobiles. So again, we see the comps, the comparisons, limited guidance. And this led to exceptionally strained margins at Big Lots. Jumping to our next page here. So you can see for the year, gross margin was down 400 basis points. Cash flow turned heavily negative. Now, management acknowledged early on last year that they had overbought inventory. And in essence, it took the whole year for them. And now Big Lots is actually 7% lower than where they were in 4Q, the prior 4Q. But that took, again, a whole lot of discounting to move that stuff out. People were hesitant to buy discretionary, so they had to, not that they were giving it away, but they had to discount things quite a bit. And you probably noticed that throughout the year, we did downgrade Big Lots twice, so now that they're sitting at a D2. So the real question with Big Lots is, where do they go from here? And what is their go-forward strategy? So they brought in a new chief marketing officer. And I don't want to go over all of these. I really just kind of want to dial in on the real estate aspect of this. So a couple things they're going to do. They're going to focus their real estate on more rural areas because they feel there's less competition there and also lower costs. They're projecting that they're going to open 18 stores, but close slightly more than that. But there's an issue with that. In the coming year, Big Lots has 210 leases expiring. And out of those 210, 48 do not have renewal options, which to me says that there could be a few more closures in what they're thinking, than other than slightly over the 18 stores they're going to be looking at. So for their outlook, again, their first quarter is really all they gave us some insight on. Still projecting comps in the low to mid-teens. Now, one thing the company believes they're going to do is improve gross margin and get it trending back up to the high 30s, which is traditionally where it's been. But again, a lot of this is going to depend on the rebound in discretionary spending. Now, if they have another year like they did in 22, it's probably going to really stress their capital and their liquidity to the point that they're going to have to go looking for additional capital in what's going to be a very tough environment. So that's not something that, we hope that doesn't happen. In the next day or two, I'm going to get our future outlook out on Big Lots, so you can see what we're thinking in terms of some scenarios and cost structures and capital structures. And by all means, if you take a look at that and you have questions on it, dial me up. So that covers Big Lots. Again, this is the one I think a lot of people have been mostly interested in. Let's go back to metrics for a little bit and talk about gross margin. Margins were hit in 22. As you can see, most companies, their trailing 12-month margin, which is really a fiscal year for most of the companies, they're down compared to 21. We had a couple outliers who actually managed to have a pop up there. Walmex stayed pretty even. They're up about 1/10. The Army Air Force Exchange, that's a kind of a different animal. But some of them, stayed at, but if you look at Dollar Tree, they actually managed their costs very well and pushed their gross margin up 200 basis points. But, overall, if we look at the average, it came down. So again, this is a result of the shift to discretionary spending, higher supply chain costs, and again, like I said, a shift in product mix, more over to staples. Okay, so SG&A margin, this is more of our fixed costs. Again, a lot of these somewhat mixed, but trending mostly higher. This again has to do with the costs going up across the board. Some supply chain issues in here. And if your sales went down a little bit, or even if they stayed flat, but your expenses went up, you got deleveraged a little bit. So therefore your margin, your SG&A margin increased. With Big Lots, we see a pretty good jump in the margin there. Again, that's a lot of the deleveraging from the sales decline. Okay, in terms of our EBITDA margin, which is really just kind of a combination of the effects of our gross margin and our SG&A margin. Again, somewhat mixed. Dollarama showing a nice increase there. But, overall, following the SG&A margin and the gross margin down. So the average again was down 130 to not quite 200 basis points. So again, just shows you the stress in the system in 2022, in fiscal year 2022. Okay, let's move on to CapEx. I don't want to spend a ton of time on this, but again, what this tells me, our company's reinvesting in the business. We'd like to see at least a 2% rate here. Most of our participants are way above that. Target there at over 5%. That's what they're remodeling. Their CapEx budget's actually going to be bigger. this coming year. Amazon, they're up. Interesting, they're double digits, but they're still down from last year. And, some of them are just, again, depends where you are. If you're opening a lot of stores, your capex is going up. So we have Dollar General, Dollar Tree. If you're just like the big boxes, you're opening a couple stores a year, 20 stores a year, you're not seeing as much spending there. And again, most of that capex for the big boxes is going into digital infrastructure and remodeling versus opening new stores. Okay. As I said, we're going to take a look at the Dollar Tree, the dollar stores here. And again, part of this to me was the interesting story in 2022. We saw consumers shift behavior. They started looking to stretch their budgets. They turned to the dollar stores for food, for some staples. And what we saw was consumers trading down to stretch their budgets. And not just, they're trading down from brand names also to private label, but we're getting trade down where higher income demographic people are coming to the dollar stores and trading down. They are attracting this. As I said earlier, consumables are up almost 8% at Family Dollar and Dollar Tree. Comps had a nice year, in part because of that. So that's kind of nice. But again, they were lapping kind of a weak year last year. Their inventory is up a lot higher, or it's higher, but interesting, that's been driven by improvements in their supply chain. They've been able to get product in quicker than what they thought. And with them, it's actually ticket driving the comp growth versus traffic. So people are coming in, buying more things. And part of it too is, remember, Dollar Tree bumped up their prices. They're now really the $1.25 tree. And they're also adding some of their other stores that emphasize they're integrating kind of the Family Dollar Tree concept, where you have more $3 to $5 items. So we're seeing higher tickets because of that. They're fairly optimistic about 23, as you can see. Comps up mid-single digits, and sales about 6%. For the full year, not quite as high. But again, still, these guys are going full speed on the new stores. Another 650 stores. CapEx budget's going to be up by 60% and approach $2 billion. Dollar General, they're looking at another 1,000 stores in 2023. So these guys are going to keep going. The question I always ask myself is, what point is saturation? And I haven't figured that out yet. But right now, if you look at the total Dollar Tree stores, it's about one store per 10,000 people, if I recall correctly. So the question is, how much more of that can we really take? Okay, trailing 12-month free cash flow to sales. Again, what this is telling us, it gives us a feel for flexibility. Because if I have free cash flow, I can do different things with this. I can pay down debt. I can fund my CapEx. That means I don't have to hit my revolver. Interestingly, if you look at the ones who are negative here, Big Lots, we would expect that because of the fall off in sales. Target, heavy on the CapEx, is somewhat what dragged their free cash flow down. Amazon, a little bit of CapEx, again, because we saw their 12% CapEx spending, along with some changes in working capital there that affected them. But again, gives me a sense of flexibility and what these companies can or can't do. Okay, let's talk about Walmart. And again, the question is, why would we put Walmart in a spotlight? Obviously, they're probably one of the strongest companies in the country or in the world. Yet again, as I said at the beginning, 2022 was an interesting storyline as to what was going on in mass merchandising. So from an economic standpoint, again, if you remember, Walmart had a tough first quarter, had a lot of people panicking, but they bounced back with 3 very solid quarters. Like other retailers, they were sitting on bloated inventory, highly discretionary. They had to work through that, but they took a very calm approach to it. They came out and said, we're not going to fire sale things. We're going to work through this. And by the end of the year, lo and behold, we're going to have our inventory back where we want. That would obviously involve some discounting. As you note there that their gross margin fell about 90 basis points year over year. Still had strong sales growth. And that was again propelled by staples. Grocery was up 13%. Now, interestingly, Walmart is closing stores this year. They've already closed 14 out of those 20. You've probably seen the headlines, Portland, Chicago, not profitable. I think there are other problems there too. If you recall, on the West Coast a while back, we had a lot of issues with people going to stores, like in essence, organized groups, and walking out with lots of merchandise. Portland has not ever really recovered from the protests back after the murder out in Minnesota. They just never bounced back from that. I have contacts out in Portland who they've still not gone back to their offices, or they only go in on the weekend. Chicago, again, they're saying is not profitable. I suspect there are other issues there. Another interesting thing Walmart's doing this year is they started unloading their digital native brands that they made such a big hullabaloo about buying a couple of years back. But to me, the interesting thing about when they bought these is that I don't know that Walmart was really that interested in Bonobos or Moose Jaw, which was a sporting goods concern that they sold to Dick's. What they were looking for was digital expertise. To me, they went out to buy these companies to acquire their digital know-how, integrate them into the system. And now that they've learned from them, the sales from these never really took off from the Walmart site once they integrated everything in. So they said, okay, it's time to let them go. And these were let go at a loss. So there was no profit in buying it. The profit to Walmart was, what did they learn about growing digital brands? Now, the real bright spot for Walmart, and this has been all year, is Sam's. Their comps have been phenomenal, and they really haven't done much with them in terms of adding new clubs. But now they came out and said, we're going to do 30 new clubs over the next couple of years. They support that with 4 or 5 new distribution centers. Sam's is a very strong engine for them right now, and I think they're positioned to take advantage of that. They were very cautious in their outlook for fiscal 24. Don't get confused with the year with that. Walmart's on kind of a funny fiscal year. So the year that just ended is fiscal year 23 in January of this year. So they're in fiscal 24 now. But as you recall, everyone got upset because inventory was so high. But now if you look at it, 61 billion back in the first quarter, it's now down below that at 50, just under 57 billion. So again, they walked through it very methodically and dealt with it. It did cost them some loss of margin on that. But the other story to me that's interesting about Walmart, again, is what they're doing. And their big emphasis now is technology and healthcare. Most of their budget last year, the CapEx budget, 9.2 billion out of about 13 or so, went to supply chain and digital infrastructure. That's not going to change in fiscal year 2024. Walmart is transforming their technology. And they announced this top bullet just recently that they really want to automate things and get so much of it done with robots and other things so that they can reduce costs. the Alert and Nap. Alert, they bought. Nap as a partnership. Between that, they're actually going to reduce the number of steps to get a package out the door, which again is going to help with that goal of reducing costs by 20%. There's another backstory here, and that is we talked earlier about unemployment and said that there are 2 jobs for every 1 person who's theoretically looking for a job, which means it's very hard to find people. This, to me, is a step in that direction to try and deal with these kind of issues, that we can't get enough workers, so what do we got to do? Well, we got to automate then. And interestingly, they did lay off at some of the e-commerce centers, partially due to automation, but they're still going to build 4 brand new high-tech fulfillment centers. And obviously they will need workers. Walmart says that these are actually going to be higher paying jobs because people are going to be using a different skill set. The other interesting thing that you may wind up dealing with is Walmart is going to start using artificial intelligence with supplier negotiations. So when an order comes in, you may be chatting with a bot and dealing with that, unless you have a really big problem that you have to get someone on the line. So again, they're thinking, again, this is going to save time, money, and into the future. So they also redesigned their interface for online purchasing, so it's a lot more friendly now. And then they're going to do 2 new healthcare centers this year, but 28 next year. So if you look down these bullets, what does this look like? Well, I'll tell you what it looks like. It looks like Amazon. These are the very kind of things that Amazon is doing. They actually laid people off too, but Amazon, again, heavy on the technology. They're moving into healthcare. So this is Walmart's answer, in essence, to stay competitive with Walmart, where they think their competitive advantages, obviously, is their brick and mortar stores. Amazon thinks their competitive advantage is their strong online presence and dominance. So that's kind of the story. So again, back to, like I said, the story this year, a couple of things. Shift in consumer behavior, more technology, dollar stores becoming more important in the food chain, supply chain issues out there still to this day. So let's look at the last couple of metrics here. This is our what's available under our credit facility. As you can see, most people have pretty significant liquidity. Big Lots, as we know, they're down, below 50%. We tend to get concerned at the 25% range. Now, Big Lots also, if you're following them, they renegotiated the lease on their Apple Valley distribution center. And to do that, they had to, in essence, buy it out for about $53 million. They drew that on the revolver. So unless they have a better quarter than I'm thinking, when we see their first quarter results, we're going to see higher debt. And, well, obviously, we're going to see close to $360 million owed on the revolver, because it was $304 roughly at the end of the first quarter. But everybody else, BJ's shifted some of that around with the term loan. So again, I don't worry about the fact that they're down at 45. But everybody else is up very, very close to 100%. Our debt to EBITDA tells us how leveraged people are. Again, this is another number where we look at about 3.5 as a warning level. And we really don't have anybody even up close to that at this point. The target is our highest at 2.5%. And again, that had more to do with their margins getting hurt and EBITDA going down during the fiscal year. And, borrowing, they swapped some borrowings out, but it's not as if they layered on a ton more debt. And everybody else, is down in the ones, which is a very, very comfortable number. So no one's terribly leveraged. Back to our free cash flow and also ties in with our availability. This tells me that companies have a lot of flexibility to deal with whatever comes our way in 2023. If the pundits are right and we have a recession, this tells us again that most of our mass merchandisers have the ability to withstand a recession. Interest coverage, again, just tells us how much cushion they have before they can't cover their interest payments. And again, Big Lots being in the negative there because that's where their EBITDA was. Everybody else is covering interest at very high levels. Given a recession, again, that tells us there's cushion there. No one's going to be missing interest payments or even debt payments. Okay, we take all our factors and we roll them in. And that gives us our credit rating. So we did have a couple downgrades during the year. We downgraded Amazon again. Interestingly, like I said, they had some negative cash flow, a lot of changes going on there. Target we downgraded again just because their margins were so stressed. Ollie's kind of in a similar situation there. And Big Lots, we downgraded them just overall because of their performance. So that really kind of wraps things up. Does anybody have any questions they wanted to throw into the chat box? I don't see anything out there. I'll give you a couple minutes if you want to think about that. But otherwise, we can wrap things up. Or if you do have questions and you'd rather just talk about them online, shoot me an email. My email's right there, jimf@fdreports.com. You can dial me up on the 800 number, and that will eventually make its way to my cell phone. So, but that's kind of the mass merchandise story. Again, it was a very interesting year from a margin standpoint, spending standpoint, the fall off in discretionary, technology shifts. 2023, I'm hoping is not quite as interesting, and some of these guys perform just as well, and that we don't really wind up on what what the economists are saying is the worst case scenario. So I'm not seeing anything in the chat, so we can go ahead and sign off if we want. Thank you very much. Appreciate you joining us.